let's also welcome on board Mr. Anand Tandon, who's an independent analyst who's joining us on the show right now. And Anand, hi, thanks so much for joining us on the show. You have the entire market in terms of the sectors. All the broad-based Nifty sectors have now tilted towards the red, with Nifty PSU banks, realty, pharma. They are one of the biggest losers today. What's still managing to hold on to, in fact, not holding on to, but least gains or least cuts rather coming in is the entire Nifty metal and energy space. What's your outlook on both of these sectors? Because while metal is something that we have spoken about right now, energy as a theme we have not revisited in quite some time. What's your outlook there?
Geopolitics. There was a small spike on the expectation that there will be further restrictions on Russian oil, for example. And now it appears that that's going to happen only a long time away. So it's not necessarily something that's impacting the market immediately. And we saw a respite because of that. So from the Indian market perspective, there are very few companies that you can really play from the energy side, simply because the prices at the retail level are controlled by the government. And now you can understand that every time the price goes up, the retail price is kind of toggled up, whereas when it comes down in the crude level, there is no change in the retail level. So there is now a cushion that has already been built in. So for the near term, I don't expect to see anything. All that can happen is if we do see a sustained increase in crude, you may find ONGC again ticking up a little bit. On the power side, if you were to call that energy as well, then obviously the most of the action seems to be on the solar. But I would prefer to think of grid as the best place to be looking at from an investment perspective. And grid-related companies, especially in the building out of the grid, the infrastructure-related companies are also companies that one could have on the horizon. But otherwise, for the most part, the market is priced to perfection and then some.
Indeed, that's about the overall space. But Anand, a very interesting point made over there with respect to the sanctions that the major countries are demanding with respect to Russian oil. Do you believe that that can actually play in the markets? That case is actually holding a bit of a probability to happen. And overall, in the global markets as well, we can see a bit of a spike. Well, of course, you did mention that if that happens, ONGC could be a bit of a beneficiary. But what's your sense that how the nations can play along and sanctions on Russian oil, is that a possibility?
So sanctions already exist on Russian oil. All that is happening now is that you're trying to lower the cap in terms of what the price at which Russia should be allowed to sell, i.e., the buyer should buy, has been lowered. Now, of course, that has also been postponed till January. I mean, you have to understand the white man doesn't do anything which harms his pocket. So while India may be the whipping boy right now in terms of saying that you've increased your purchases of oil, the reality is that most of Indian refined product coming out of the oil is being re-exported to Europe. So it is Europe actually which is benefiting, and we do benefit from the fact that our refineries are doing well. But aside from that, it is not as if the domestic consumption is driving most of this. That said, overall, there is some possibility that there will be a further down dig in terms of Russian oil price, in which case there may be, some amount of constraint in terms of supply. But given the state of the global market, that has been more than offset by the fact that there isn't enough demand as well, and therefore we are not seeing any major problem coming through at this stage. Rather than energy, I would think the bigger issue was and continues to remain to some extent the rare earth metal sector, which China is controlling. Of course, they have released some of the pressure in the last 1 month, but to my mind, that's a strategic threat that they hold and will continue to hold for a long time.
Okay, so that's the take on what we can expect on that front going ahead. But let's once again revisit some of the stocks on the charts. And Akshay, coming to you, what's your take on something like a Glenmark Pharma and a DV's Lab, the top two stock losers when it comes to the entire Nifty Pharma pack? How are they looking like on the charts? And given the consolidation that we're seeing off late in pharma, can we say a reversal is something that you're spotting?
The charts for Glenmark are a bit overstretched for comfort. Now, if you recollect a few trading sessions back, there was a very strong gap up right from 1900 to 2100. And, post that, the stock has been kind of getting sideways, getting a bit of a cool off. But broadly, the trend is strong. So I would be more comfortable for placing the trades on the long side or holding positions if you have, because the support now of 2100 is a very good support, and I think again buying should resume once we get near the levels of 2100. So positive view maintained on Glenmark. And as far as DV's Lab goes, DV's Lab too has been trading in a positive zone, just that it's a bit overstretched again for comfort. You have a cool off scenario from 7000, and once it gets back near the zone of 6400, which is a very strong short term support for DV's Lab, I think buyers will be interested to buy once it gets near 6400. So buy on dips is the call in these pharma names. Trade as per levels at the levels or the supports I mentioned.
All right, so that's today coming in on select pharma counters, which are indeed actually in the red today, but nearing those key support levels for themselves. But the other stock that is going to be in focus is actually Dixon Technologies. The company is set to release its Q1, and this time as well, we are expecting a double-digit growth number on across the metrics for Dixon Technologies. But along with that, the key to watch will actually be the margins. 3.7% is what we are expecting, and that could actually be lower on a sequential as well as on a YY basis. But specifically, the reason for that stands at that the company's product mix is likely to shift towards the lower margin business, that is mobile as well as the EMS space. And along with that, in terms of the smartphone sales, Kotak Securities do believe, or Kotak Insti rather do believes, 9.5 million units in Q1 FY26 to be driven by motor export volumes as well as higher domestic volumes as well. So on and all, what we can expect is a double-digit growth, but the margins will be the key to watch out for. But when I help us with the chart check on this one, because of late we have seen volatile moves on Dixon Tech, but it does still remains those investor and trader favorite stock as well. How do you see the setup for this particular counter? Vinay, I guess you have to unmute yourself.
Yeah, sorry. So it has performed well in last 1 month from the lower level of 13,300. It has gone up to 16,450 odd level. So obviously it is into a moment, good bullish momentum, and it has been trading above important moving averages as well. So technical setup till now has been very positive, but result needs to be seen, and the short term resistance I see around 16,500 that needs to be tracked, above which it will again resume its trend. Because the stock is overall trading into some symmetrical triangle on the monthly chart, and that resistance of that triangle comes around 16,500. So we need to see whether that is being taken out or not. So yes, existing long position should be held, and the trend has been positive, but further bullishness can be expected only above 16,500. So stock is trading very near to the resistance zone. So it is better to wait for that level to be taken out, and better to wait for the results as well. So 16,500 should be tracked as a resistance. As far as support is concerned, I see a strong support around 15,700 for the Dixon Technology for the short term. So 15700 is a strong support, and 16500 is a strong resistance.
So that's the take on Dixon on the charts. Let's take a look at a stock that's going to be in focus in tomorrow's trading session, and that's going to be Tata Consumer on the back of its first quarter earnings, and it's expected to be largely a mixed. So here's what you're expecting when it comes to Tata Consumer's earnings, because in terms of the revenue that we're seeing an uptick of about 10.5% at around 4,813%. This, of course, on a consolidated basis. EBITDA is somewhere we're seeing a little bit of a pressure building up, a cut of 3% on a year-on-year basis. Once again, on the profitability front, we're seeing a good jump of 22.5% on a year-on-year basis, anywhere between 350 and 355 crores for the EBITDA. And margin also, once again, because the EBITDA is under pressure, the EBITDA margin also to take a decline at 13.5% compared to 15.3%. Lots to watch out for, lots of moving parts when it comes to Tata Consumer, given the wide portfolio of businesses they have. Overall volume growth we're expecting at 6%, tea volumes anywhere between 3 and 4%. The RTD volume, which is a ready to drink portfolio, could grow 10%, but the value growth here could be flat, because remember, this summer this time was hampered by early monsoons, and this has impacted the entire summer beverages or that summer portfolio drink segment of theirs. Salt is expected to perform well, so is the case with Capital Foods and Organic India. Tata Sampann expected to grow between 25 and 30%. Soulful also should look strong this time around. The overall India food business like-to-like growth is seen growing 14% on a year-on-year basis. International business, we're expecting to grow 4% on a constant currency terms. Non-branded to also grow 8%, and it's actually the other income that could this time be boosting the PAT. So fundamentally, it might not be all that strong, but nonetheless, a mix it is what we're expecting. Lots of factors to watch out for when the numbers come out in terms of a raw material trajectory, in terms of tea and coffee pricing, outlook on competition, any price hikes if they've taken, volume guidance. So much to watch out for. So all eyes are going to be on this Nifty 50 major. But Akshay, a chart check on Tata Consumer. Given that we were just discussing some staples some time ago on the charts, and if you had to get your preferred pick on the FMCG space, would it be Tata Consumer on the charts, or is there a better looking chart from the group of stocks?
See, for Tata Consumers, what I understand is from the short-term perspective, I was just going to the weekly charts. The last 5 to 6 weeks has seen 1050 level working as a very strong support zone. It also somewhere coincides to be around the 200-day moving average for the stock. It's been a slight corrective phase for the script, but I think 1050 is a good support for the July series. And from here, even if there are small whipsaws post the results, this level of 1050 should be defended. In case it does, then you can expect a recovery, which can see the stock testing 1140. But if I have to pick up one name from the FMCG pack, which will do well, it has to be Dabur, which has a good strong technical setup. It was one of my calls which I discussed at the beginning of the shows. So that technical setup works well from a momentum catching perspective.
Point taken that Dabur remains the preferred bet when it comes to the consumption basket. But Mr. Tandon, help us with your take on the whole consumption and the staple pack specifically, because in the last quarter, most of these companies have disappointed onto the volume figures specifically, and the leader being HUL there. But this time around, given the Q1 updates have been decent so far, do you believe that now is the time to maybe look at for some of those staple companies within consumption?
Well, it's going to be hard for these companies to deliver anything great. Just think about it like this. Most of these products are products that can only increase in volume terms by 4 to 6%. They are reasonably well penetrated, and beyond that, you're not going to get any growth. In a situation where, if you believe the RBI, we are looking at an inflation number which is going further down. In that case, let's say add another 3% on inflation, your top line will be single-digit growth. With a single-digit growth, how can you expect to get a double-digit bottom line growth? In most cases, it won't happen because there is simply not enough to take the juice out of. These are well-run companies. They've already been operating at fairly good, operating margins, etc. So it's not like you can squeeze prices anything more. So all you can do is lower the quality, and that becomes a problem in terms of their brand quality. So net, you are likely to see, with the falling inflation, FMCG companies in general underperforming. It's only in inflationary situations that you find that there is a need to look at FMCG as a defensive play.
Okay, so that's the take on FMCG, but let's just focus and talk about BFSI, the entire banking and financial services space. While many financial stocks have run up in the past few months, Harsha Upadhyay of Kotak AMC likes select names on the back of multiple tailwinds. Let's go across and revisit the conversation we had with him earlier on the day to understand where amid the entire financial markets or the financial space he's seeing value at the moment.
Within banking and financials, I think there are certain names which are doing well. And whatever the impact of repo rate cut on the names is also probably more or less behind us. So to that extent, I think things should be fine in this basket as well. There are certain banks which are delivering on growth as well as asset quality. There are certain other names which are finding some headwinds on either asset quality or on the growth. I think that's where you need to look at all of these factors and also keep valuation in mind. The banking and financial sector, while it has outperformed in the last 6 to 9 months, is no more very, very attractive in terms of valuations, right? I mean, we have seen some absolute performance as well as relative performance from this basket. So to that extent, I think we need to keep all of this in mind. And as we discussed in the earlier part of the show as well, this is unlikely to be a season where you will see too much of growth across segments, across businesses. So to that extent, you need to be careful in terms of what valuation you are paying for some of these names and how resilient would the earnings growth be as you go ahead.
All right, so that was Harsha Upadhyay's take on the BFSI space right now. But Mr. Tandon, of late the earnings season hasn't been that well so far, and this time the expectations were also not that great. Given the fact that yes, of course, there has been some outliers with respect to earnings, but any pocket that is looking interesting to you, or rather you will be closely looking at with respect to good hopes on the numbers?
Very hard to find as a sector. If you look at where we had started from, while the expectations may kind of have been muted, if you really look at it, you were still starting the year with a 14% earnings growth expectation. Much of it was coming out of, for example, banking and finance. Some of the large numbers in banking and finance haven't delivered, and most of the other areas are going to struggle. In my view, we will have a weakness in consumer, which is contra to what people are saying. Consumer durables and consumer discretionary in particular, I expect to go weaker into the second half. If that were to come through, I think you're looking at a single digit, maybe half, 4-5% growth in the index at this stage, which means that the index is grossly overvalued at 23, 24 times. So you're already paying for perhaps not just this year, but the next year's earnings as well. In that scenario, finding a sector which is cheap is not likely. All that you can hope for is a sector which will continue to grow because the runway is long, and you hope that finally valuations will catch up, and therefore one continues to remain bullish on things like insurance, etc., where once the investor gets in, it's very difficult for him to get out.
That how should one evaluate a sector like EMS, because we will be looking out for numbers for Dixon, and we all know at what valuations such stocks do trade at. But on the flip side, the growth is still in the double digit. The growth is still surpassing the growth that we are expecting or for the broader market as well. How do you believe that the markets will reward such counters, and how will they take it?
So for now, the market seems to be extremely bullish in terms of growth, given the fact that we have very little growth across most sectors. Anything which is showing good numbers in terms of the top line, one is not worried too much about the bottom line. Take the case of Eternal, for example. It is trading at valuations which assumes that India and China combined will be buying stuff from Zomato. But it doesn't matter because the top line continues to grow. The same thing will hold for Dixon at 4% margin. It is actually perhaps not even making money if you were to remove what the government gives it. The hope was that it will backward integrate into other areas of components for mobile. That may or may not happen, given that many of the mobile components require magnets. And as I said earlier, most of them are dependent on China. So while we may continue to buy components from China and put the screwdrivers and put the screws on into the phone and set them up and claim that it's ours, the reality is that much of it isn't. You have to be looking at other products to make, and given the context in where we have a belligerent US president who wants to put tariffs on everything and everywhere and wants to move the manufacturing back into the US, you have to assume that overall export growth in the world as a whole will slow down. Anything which is working on the assumption that exports will continue to be growing at the same robust pace as they were, let's say, a couple of years back, not likely to happen. Given the valuation, there is no scope for no scope for negative surprises. So yes, will it go up? Perhaps it will, because the volumes will come through. Will it make money over even a medium term? Well, I would think that you should have some valuation reset before that were to happen.
Okay, so that's the take, but let's talk about the last few minutes of trade right now, and let's once again reconnect with our techies. Akshay, what's your take on where we can expect to open tomorrow, given the kind of subduedness we've seen in the market? Yesterday was good, today was okay. Can we expect tomorrow to be good once again?
Yeah, it looks probably like a flat opening tomorrow. 25,000 has reclaimed yesterday. Today was a bit of an off day. Probably, the writers were at its best on the Sensex weekly expiry day today. But the short-term setup still has promised to see up the bump up, which can go all the way till 25,300. So still optimistic that for the coming weekly expiry for Nifty, 25,300 is on the cards.
All right, so that's the take on Nifty 50 right now, with just a few minutes left before we should shop. And What's doing well, of course, is Eternal. That stock is heading for a very strong closing for itself. But apart from this, some of these life insurance counters are doing well. Metal, of course, that is showing a bit of a jump up. But Mr. Tandon, any take on metal as a pack? Because of late, the sector seems to be doing well. Even the earnings from JSW Steel wasn't that bad. But do you believe that they can actually bear the storm in the markets and the valuations are also reasonable?
Well, steel in particular has a lot of things going for it for the simple reason
I
that there
don't
has been a
think
volume
the
expansion, while at the same time the government has been protecting the industry by putting anti-dumping duty on all and sundry. So, from a domestic perspective, any company which is operating only in India will likely continue to report relatively robust performance. The global demand scenario, to my mind, doesn't look all that great, and therefore, it's not very likely that commodities as at least metals as an asset class will necessarily do very well. There will be segments. So we've already seen things like copper has done well in the recent past. So has palladium, platinum, and so on. Those are not plays that you can do in India. So you are pretty much left with steel and aluminum. And I think as I said, given the protectionism that we are demonstrating, they will likely continue to remain protected, especially the Indian companies.
Okay, so that's the take on metal and particularly steel in focus. But Anand and Akshay, thank you so much for joining us. As we start winding down for the day, we'll let you go.